So the format of this session, we're fortunate to have an esteemed group of panelists. We have Steve Lividitis, Managing Director of East Dill Secured, who will lead us in an overview of the market and share some slides of what we're seeing in the real estate and hospitality sectors. And then we'll have a Q&A session with Doug Lyons, Managing Principal of Pearlmark. We have Robert Ivanhoe, who's the Vice Chairman of Greenberg Traurig. And then we have David Tessier of Hospitality and Gaming Advisors, and he's the President and founding member of Hospitality and Gaming Advisors. And then we'll go into a brief overview of what they're seeing in the marketplace, and then we'll engage in Q&A. And over to you, Steve Lividitis of East Dill Secured.
Thanks, Jeff. Welcome, everyone. If you could flip to the next slide, please. In terms of the current themes in the market, we wanted to give a bit of an overview, and then we'll get into a few specifics. Obviously, transaction activity is down substantially across the board and across the country, with a couple notable exceptions. The hospitality sector, as you can imagine, has been hit the hardest. The debt markets at this point are more than slowly thawing. They've thawed with a couple exceptions and showing good life. One of the biggest issues in the debt market is we are seeing transaction velocity on the debt side with less involvement from the banks. If you recall, earlier in the year, a lot of the big money center banks had lines of credit drawn fully by the big corporate clients, such as Boeing and across the board, and that has put some limitations on bank balance sheets to be as active on the real estate lending side as they had usually been, and that's been pretty much limited to the top 6 or 7 banks in the country. The super regional banks have remained very active. Since the beginning of the COVID outbreak, many deals were put on hold. We are seeing people now more actively engage in the debt market, in part because the equity sale market is still very difficult. So the debt market on a relative basis is much stronger. Fed intervention has been helpful and will continue to be helpful. The Fed has been purchasing a variety of bonds and real estate bonds and really providing a strong underpinning on the credit story. So that is certainly helping stabilize and in some areas fuel the debt underwriting. Next slide, please. Just to focus on the lodging market, and David will, who's a specialist, will dwell on this more. Obviously, we've had a huge fall off in lodging overall. If you look at the next box to the right, there's a significant amount of capital that is eager to get back into the lodging sector, and our experience has been we've seen more anecdotal people looking to reinvest in lodging and waiting for an opportunity to invest in lodging than in retail or office. A lot of people seem to recognize the opportunity, and lodging has typically been a quick turnaround and a quick recovery in some cycles, and you can make a lot of money quickly if you time it correctly. And so we have a lot of money on the sidelines waiting to come into lodging. The debt market for hotels and hospitality has been very, very challenged. We are seeing loans approaching the double digits in some cases, whether that's senior debt and mezz combined. There is some preferred equity coming in the market. So there is, while my prior slide talked about the debt markets being improving and active for lodging, interestingly enough, it's been lagging. Drive to leisure markets and drive to destinations are doing fantastically, as you can imagine. So, wherever you are in the country, if you think of places where people might drive to, there's been a strong occupancy, really good performance, and it's come at the expense of a lot of the big fly-to resorts and the big luxurious downtown hotels in various cities. We are expecting a favorable supply and demand market for lodging, and so that, you know, if the travel picks up, you could see a quick rebound because the supply has been really constrained. And finally, skipping ahead, you know, people are figuring out how to, you know, we've seen now how ugly it's been. Just a quick statistic, you know, RevPAR, which is one of the primary statistics used in hotel evaluation, RevPAR was $81 a room in February. It dropped to $18 in April, which is staggering. It's recovered to approaching $50 in August. And so, you know, the point is that people have learned how to underwrite now. They've seen the whole cycle, this whole COVID cycle. They've seen how difficult it is. I think people are getting comfortable underwriting hotels, and we're going to see hopefully some increased activity in the first quarter because of that. Next slide, please. As you can imagine, this slide shows the overall transaction volume in the 5 big sectors. Obviously, down across the board. If you would, and I unfortunately didn't have time to do this, if we subtracted out the first quarter statistics on the year-to-date, it would even be more larger red numbers. So across the board, you know, anecdotally, not just anecdotally, but the evidence has told us that industrial is probably even stronger than this would indicate here. And there's a couple other sectors that are not on here, life sciences and data centers and such that are doing very well. So again, I think there's some bright spots, but this has been a very difficult environment, and these numbers reflect that. Next slide, please. Here's an interesting look at the public markets, and this is probably more reflective of where we see interest on the private side. You know, data center and industrial, people love investing in real estate right now where basically doesn't have humans occupying it. So lots of interest in those sectors where life sciences, where it's up only 1%, that's misleading. That really is possibly the hottest sector in real estate. Massive amounts of capital and interest. Everybody, every big fund, every big sovereign fund, every big institution is looking on how to invest in life sciences, and we're seeing office buildings being successfully converted to life sciences in certain markets. So this is probably understating how aggressive the market is for life sciences. And then moving to the right, again, we work our way off to the right, and you can see that the regional mall and the lodging companies all the way to the right are the bottom of the pack, and that's certainly reflective of what we're seeing in the private side. A very difficult environment for shopping center public companies and hospitality public companies. Next slide, please. We have touched on this before. There is a massive amount of built-up capital on the sidelines in the closed-end funds looking to invest in real estate. It's up, 2.5x since 2012. Slight drop-off from 2019 to 2020. Which accumulation of capital, this is why we hear a lot from people looking to invest in hospitality and some of the distressed sectors. I would say a lot of the closed-end funds that are reflected on this chart are very comfortable investing in hotels and looking for an opportunity to do so, as well as all the other sectors. So, in terms of our transaction velocity, we could see a quick recovery, in part because as you might imagine, fund sponsors are not, the choice is either invest or give the money back. They'll find a way to invest, as you can imagine. Next slide, please. This is a chart of the 10-year Treasury just roughly for the past 2 weeks. You can see last week we saw a noticeable uptick in the rate on the 10-year. Still low, but the trend is really interesting. The market early last week started reacting to the potential for a blue sweep and concerns about spending and interest rates associated with that. So again, rates are still low. The forward curve indicates a 10-year in the current, possibly Democratic administration, a 10-year that would be somewhere in the low to mid 1% range. So still low, but really interesting how the market noticeably upticked on the rates over the last week and a half, and stirred up a little bit of concern. Next slide, please. In terms of conclusion, the real estate industry is probably, along with the travel industry, has been hit the hardest in terms of big industries in the economy. We are seeing it's a very resilient industry, and we are seeing transaction activity in all the sectors perking up, even though in a difficult environment. We firmly believe that there's going to be a strong rebound because of the amount of capital that's piled up and because of the low interest rates. And so we expect to see really increased velocity and a stronger market next year. Finally, business travel has started to resume. We've all, some of us have been on planes frequently through this whole cycle, but I'm hearing more and more people starting to travel, go to New York, go to LA, go to Chicago, go to big cities, and we're seeing more of that. So as business travel improves and therapeutics and vaccine prospects increase, we think that's all highly correlated with the success of the real estate market. Thanks very much.
Okay, excellent, Steve. Thanks for the overview. And so I'd like to welcome each one of the panelists now on stage, our virtual stage. And again, we have Doug Lyons, who's managing principal of Pearlmark. We have Rob Ivanhoe, who's the vice chairman of Greenberg Traurig. And then we have David Tessier, who's the president and founding member of Hospitality and Gaming Advisors. So I'll ask each one of them to give a quick overview of what they're seeing in the marketplace from their perspective, and then we'll open it up to Q&A. I have prepared questions, but would love for questions to come in from the audience. So let's start with Doug Lyons, and then we'll have Rob give an overview, and then David Tessier. Over to you, Doug.
Yeah, we are a middle market value add equity investor in office and industrial and apartments, and we also run a credit strategy focused on providing mezzanine capital or gap financing to borrowers, largely in those same sectors we're active in from an equity perspective. And I would agree with Steve's comments. Our transaction activity has been down significantly this year. We are starting to see a pickup, and I'll comment probably later on some interesting investment opportunities we're starting to see. But since COVID, we were largely all hands on deck from an asset and portfolio management standpoint, just trying to get our hands around what the impact of the pandemic is or has been on our existing portfolio. Fortunately, we don't have much lodging exposure. We have very little big box retail exposure. The retail that we are exposed to is largely supermarket anchored, which has fared a little bit better. I would refer back to Steve's charts in the public markets, and you can see that the strip centers are doing a little bit better than the malls, for example. And then office for us, because we're in the middle market, we didn't have a lot of exposure to larger capitalization CBD assets in markets like San Francisco, Chicago, or New York. And so we've been faring pretty well. And now in terms of areas that we're looking to play offense on, for us, it's been, again, middle market multifamily. It's been apartments that are market rate but affordable. So avoiding some of the a higher price point luxury product, in particular in down markets. And then the credit strategy, following up on Steve's comments, is really starting to pay dividends, because as Steve mentioned, the banks are pulling back. There's been some dislocation in the credit markets, but they're active because the interest rates are still relatively low historically. And if you can't sell a property into this market, you're going to need to refinance at some point. And so our strategy of providing that gap subordinate financing to top off either a conservative bank loan or an insurance company loan has been in strong demand.
Okay, excellent. Thanks, Doug. Over to you, Rob.
Good morning, everybody. As some of you may know, Greenberg Traurig is a very large global law firm. We actually have the largest real estate practice in the United States. I'm based in New York, so probably 75% or so of what I do is New York area, and the rest is national or international. As a New Yorker, speaking about the New York market, it's just been pretty horrendous following the onset of COVID. We were very, very busy in the fourth quarter of last year and the first quarter of this year through mid-March, probably about as busy as we've ever been. And then, once COVID really set in, things came to a halt. And when I look back in mid-March, I probably had about 30 different kinds of deals on my plate, and 90% of them didn't get consummated. And that goes from things that were under contract to things that were just in early negotiation or due diligence, covering everything. But 90% of them, just did not move forward. Several of them ended up in litigation, and deal sizes anywhere from 50 million to 6 billion. So it really kind of, in all asset classes. So that was pretty consistent. The ones that did go through were multifamily and industrial, which is really kind of emblematic of what Steve was saying in terms of the stronger parts of the market. Since that time, again, in New York, the biggest distress has been in hospitality, but it's not yet led to much in the way of lenders taking action. It's more, against borrowers and going to foreclosure. There's been some activity by mezzanine lenders who, in anticipation of the need to protect themselves against the senior lender, have started to move forward on defaults and even some UCC sales. But other than that, most senior lenders are being pretty gracious about forbearance, and so there's been a lot of forbearance activity. There's been a fair amount of hotel restructuring also, but those take sponsors and owners who are willing to put more money into the hotels to refill reserves. And if a sponsor's not willing to do that, I think it's going to be harder and harder to keep kicking the can down the road at a certain point. Their lenders are allowing reserves to be invaded in hotels to carry it for a while, and if they don't get refilled, then the clamp down should start to happen. So around the rest of the country, I think what we're seeing is good activity in industrial and multifamily in particular. The gateway cities, I think, have been affected the most. New York, San Francisco in the slowdown and the after effects of COVID. And leasing activity has just fallen off a cliff in New York. So that's way down. That'll probably lead to reduction of rents and ultimately reduction of valuations in New York City when it comes to office. Of course, many stores are boarded up, so the retail sector is struggling. People can see that when they walk around on the streets very, very easily. So, not a pretty picture, but I think, we will come out of this, and a lot of it will just follow the science.
Okay, thanks, Rob. Over to you, Dave Tessier.
My company focuses on developing hotels And we have a consulting business, asset management business. We do a lot of debt restructuring, loan modifications. So you can imagine we're quite busy right now. The COVID crisis has really impacted the lodging sector probably the most. It's been devastating to our business. Running single-digit occupancies during the week, in some drive-in markets running strong occupancies, but really the whole industry in general has been battered. I think to Steve's point, at one point in the month of April, we were down to $20 RevPARs nationwide. 18% of all U.S. hotels were closed in the month of April. Almost 30% of the hotels in New York were closed, and even a higher number in Hawaii. So resorts have been hit. We do see the drive-in leisure markets rebounding quite nicely. The smaller metropolitan areas, your Asheville's and Key West and Charleston, South Carolina, those smaller, and to a certain extent Nashville, but the smaller markets we've seen recover quicker. I think as we look at this, the PPP money helped us to a certain extent. The lenders, either CMBS or balance sheet lenders, have been fairly good about, to Bob's point, about allowing the use of reserves, or doing some type of a modification. Everybody really was looking at a 3-month modification, 3-month deferral to start with, and I think everybody recognizes that ship has sailed, and there's going to be a second bite at the apple. So we're really cautious about our future. Hopefully the smaller hotels, obviously interstate hotels have done really well. Smaller hotels have done well. If you look at hotels under 300 rooms, they've averaged about, in the trailing 3 months, they've averaged about 45% occupancy. Hotels over 300 rooms have been averaging around 20, mid-20s, low 20s. And when you start looking at 1,000-room hotels, they're averaging less than 20% occupancy. So we've got a road to go.
Okay, thanks, David. So that overview was helpful from each one of our panelists, as well as Steve Lividitis setting the stage. So I have a series of different questions, but I encourage the audience to use that chat feature, and if you could let us know your questions so we can incorporate them into this session, because we'd love to have this be interactive. So one of the questions is around office and office demand going forward. We spoke earlier about Larry Fink, the CEO of BlackRock, his comments yesterday about their future and their footprint in the next new normal and what that would look like for BlackRock. Last year at this conference, we spoke about WeWork and the future of co-working for many companies. What do we see as the demand for office in the new normal going forward, especially taking into consideration social distancing? Do we see that demand in the city? Do we see that demand shifting to more suburban markets? So maybe we could start with Steve Lividitis, and then we can ask each one of the panelists to jump in as well. Steve, your thoughts on the future of office and the demand of office space moving forward?
Sure. Couple things that we're seeing. Number one, owners that have a modern building that can easily be modified in terms of adding some of the new technologies to get people to feel safer to come back into the office are going to have a huge advantage. What are those technologies? Obviously, adding different types of filtration, UV filtration, HEPA filtration. Having a modern HVAC system gives you a head start, and people that are doing that. Number two, elevators. If you have modern elevators, a key thing is limiting the number of people to an elevator and being able to get people up and down quickly. So a couple of the new buildings in Chicago believe that they can, by accommodating no more than 4 people per cab, that you would never wait more than a minute to get anywhere in the building at any time. And so people that have capital that can and a modern enough building that can invest in that technology are going to have an advantage. So that's and then finally the touchless everything, touchless bathrooms, touchless elevators, touchless security. So getting people back in a building and not feel like they have to touch too much is another advantage. So that's what we would call the technological aspect. The other thing that we're seeing is a lot of in Chicago and other markets, a lot of big service companies, law firms, accounting firms, consulting firms that were previously, you'd never think of them leaving the Loop or the financial district, are starting to look further outside the downtown area in order to get either their own building or be part of a smaller building where they can control their own lobby. So I think we're going to see a lot of bigger companies of all types focused on getting into a building where they can control their own environment, control who's coming in and out, and that typically means going further out of the downtown area into a small building and a shorter building. So I think part of that is also being able to walk up and down a couple flights of stairs without having to deal with elevators, and then having lots of open space, exterior space around, which is tough to do in a traditional downtown building. So we are seeing a number of, bigger tenants, law firms, and service firms looking for those types of different environments.
Okay, great. Thanks, Steve. Any other panelists want to jump in on office demand going forward or thoughts?
I'm happy to. I'll put on my user's hat. We have over 40 offices around the world, and for the last 20 plus years, I've been effectively the head of facilities. It goes with the global practice chair job. The punishment is you are the business person in charge of the firm's leases. So that would be me. And we have been for the last 6 months kicking around, what are we going to do going forward? Are we changing our leasing requirements or leasing standards? How are we planning on mixing in more people wanting to work from home, social distancing, all of those things? I strongly believe, just from my own point of view and from speaking to a lot of clients who are also tenants, that this is going to be something that's going to take some time to evolve, and to look at where we are today, and we get to the point where the virus is under control through hopefully efficacious vaccines. It will be different, but certain of the trends that were happening before have been accelerated, like work from home. So we're anticipating a footprint that's probably 10 to 15% smaller in each office long term, because people are going to want to work from home. We're trying to figure out exactly how do we implement that. We're really not shrinking our office sizes or expanding them, because we never went to open plan. A lot of law firms started to go to open plan, and fortunately we didn't. But we have continued over the years prior to COVID to really reduce the square footage per lawyer of the firm's footprint, and that will continue as our leases roll over. So in some offices, we're moving from, let's say, 800 or 900 square feet per lawyer into a new office where we might be 530 feet per lawyer. But that's something we were doing anyway. That's not as a result of COVID. So long story short, for us, I'd say maybe 10 to 20%, depending on the office, reduction in footprint.
Okay, great. Thanks, Rob. So let's pivot to a question really about capital markets and lending, and both from, let's say, multifamily as well as mezzanine, as well as what we're seeing in the hospitality markets. We're seeing lenders start to threaten foreclosure. Are they extending? Can you just give us a feel? Maybe start with David Tessier, and then we can move to Doug Lyons.
Yeah, I think, again, what we talked about a little bit earlier is that right now the lenders have been pretty good to work with, especially if you had cash coverage ratios north of, 1.5. I think the lenders are looking at this as this is a short-term problem, and if you have a long-term asset that's doing well, they've been pretty easy to work with. The CMBS guys have not been sending people to special servicing who have been keeping their interest and tax reserve, their insurance and tax reserves up to date, and they've allowed consent agreements to be able to use your FF&E funds to pay for debt service. So that's been great. Other CMBS lenders will shoot you right to a special servicer. You have to pay additional fees, but again, have been pretty good about giving that 3-month extension, the use of reserves, as long as the borrower is paying taxes and insurance current. We have seen everybody's been very good. Most lenders, balance sheet lenders, and CMBS lenders have been good about not enforcing loan covenants for debt service coverage ratios, for net worth and liquidity of guarantors, for funding of reserves, for not paying franchise fees as long as they get something from the brands, and the brands have been very good about financing franchise fees. Hilton, for instance, has given a year deferment at a 5% interest rate for franchise fees. PIPs, the property improvement plans, things like that. The lenders are not requiring that those get completed, provided that there's a comfort letter from the brand. So for the most part, I think lenders in this first round have been good. We actually had a balance sheet lender on 7 hotels that actually provided an additional $15 million in rescue capital to allow the hotels to get past the 3 months that they obviously could not get past. I think, to everybody's point earlier, we're going to see a second wave of this. And I think you are going to start seeing where you've got mezzanine lenders, preferred equity people, guys that can do UCC foreclosures. You may start seeing some of that activity, but so far, I have not personally seen a lot of that activity. I think there's been 2 hotels that I know of that have proceeded with foreclosures. But for the most part, I think we've been very fortunate up till now.
Okay, that's great. Thanks, Dave. And then let's go to you, Doug. And then I think
Sure.
we are going to have to wrap up after that. We've covered a lot of ground on the panel. Your thoughts, Doug?
Yeah, just commenting on the debt capital markets. In terms of the asset classes we're active on, debt is plentiful in multifamily in particular. The agencies are still actively lending. They've gotten a little more conservative on underwriting. They're requiring higher reserve levels, but they're still very active and open. And coming in behind them, there are a number of other institutional lenders that would love to increase their exposure to multifamily. So multifamily has not been an issue. And in fact, we're involved in a couple smaller scale ground up development projects in multifamily. And to Steve's earlier point, we're not going to get a construction loan from one of the larger money center banks, but a lot of the regional banking lenders are still active and open. They're not going to give you, 65, 70% of cost, but they're comfortable at 60% of cost. And for that reason, on our subordinate lending business, we're actively topping off some of those construction lenders for best-in-class developers. So, yeah, to Steve's point, capital markets are open. I think one thing you're going to see is a pickup in activity. So Dave talked about lenders sort of, pushing out, with forbearance, extending another 90 days. But at some point, the music's going to stop. And I'm seeing a lot of broker packages now in lodging in particular, in retail in particular, where lenders are interested in selling their loans at discounts because they don't want to get into the restructuring. We're just starting to see that, which is usually the canary in the coal mine in terms of much wider scale workout situations. So, I think that right now is really going to be over the coming months focused in lodging and retail, but there are going to be some issues as we discussed in office as well. So I think, just picking your spots and making sure you got strong sponsorship. To the point made by Dave, if you have availability of equity capital and you're willing to commit to invest in an asset and protect a position, a lender's going to work with you. In our mezz book right now, we've been fortunate, as I mentioned earlier, we don't really have lodging exposure, very little retail. And 3 of our multifamily credits have paid off just in the last 45 days. 2 were developments that were completed but not fully leased up, and the borrower got the senior lender to agree to allow the mezz to get paid off in cash from liquidity by the borrower. And so we were paid off. Another recent payoff was an age-restricted multifamily 55 and over living. And the borrower basically sold the asset and paid us off. So we are starting to see sort of a pickup in activity along those lines.
Okay, perfect. Thanks, Doug. And listen, we covered a lot of ground in this session, and I just want to say thanks on behalf of Marsh to you, Steve, Rob, Doug, as well as David for sharing your insights. I think the audience certainly gained from this session.